Welcome back. It's time now for On the Radar, where we ask an investing professional what they're looking at in today's markets. We're back with Patrick Horan. He's a portfolio manager at Agilith Capital to get more of his views on what he likes in this market. He's explained already why he likes small caps within different sectors of the market you like, among others, financials.
Financials, yeah. Financials to us look good. Life insurance companies, asset managers, and banks. Some banks are positioned differently in Canada than others. We kind of like the Canadian pure plays, CIBC, National in particular. And I know it's a very narrow base, but we think the U.S. still has issues to work out with overinvestment in commercial real estate, which a lot of them are tied up into. But getting back to the meat of the presentation, yeah, we're believers in that we're seeing a kind of a broad-based economic boom right now, especially compared to what we've seen over the past 10 years. And it is taking portfolios by surprise. I think for the most part, portfolios have been positioned for a very low growth, very low return environment. So predictability was the key. Now that's turned upside down, and you want more cyclicality in your portfolio. And across the board, what we see is the cyclicals are still very cheap. They're still underappreciated and underowned. And we think that's really where the opportunity is, especially if you see the backdrop as a higher growth, higher productivity environment right now. And I don't see how you can make an argument that we're going into recession or that there are any issues. So you have to ask yourself, why would you own a guaranteed investment of 4% when if you have real GDP growth of 3%, inflation of 3%, you're getting top line of at least 6%. With operating leverage, that should turn into 10 to 12. So on a cheap stock, 10 to 12, no multiple expansion should get you a double-digit return just from earnings growth. And we think the market's mispositioned, so there will be multiple expansion from that. So you can see, a 20 handle on that return potentially. That's the opportunity that we look at. The sectors that are going to benefit from that are industrials, your cyclicals, your financials, and your small caps. And we see that playing out for the next 3 to 5 years.
You made an interesting comment in our first conversation together where you referred to the S&P TSX Composite as poised to, I believe, rip higher, as have other major indices. That sounds like a bullish call then on the Canadian financials, which are such a huge part of the index.
That's right. That's right. Yeah, we think there is global growth that is happening. We think the U.S. dollar has been a suppression agent for this growth, and we're seeing pockets all over react very similarly, independently of each other. So we talked about Germany and France and Japan, all breaking out and doing so more in an organic sense. There's not stimulus coming into these places. They've recombined their assets. They're starting to grow again and grow well. And there's a happy medium right now between interest rates, unemployment, and growth. And you don't have to shape a portfolio based on the fear of something happening, which is really what the behavior has been over the past 10 years. So basically seize the day. These are very good time for equities, and but the stocks that are going to benefit the most from it are actually the cheap ones, and the market has forgotten the principles of cheap stocks that outperform are winners in the portfolio. And what we've seen is a bit of an anomaly over the past 10 years where stocks that have momentum, that are safe or appear to be growth and safe, have done well. So I think we're flipping things kind of upside down. But when you look at the past 75 years of investing, that this is more the norm than what we've seen over the past 10 years.
Okay, time for some notable calls. The analyst team at BMO is turning bearish on Canada's big telecom players. This morning, we saw the firm's analyst team downgrade two of the biggest, BCE, which is the parent company of this network, and Quebecor, both to market perform from outperform. In addition, BMO cutting the price targets for these names. The analyst there, Tim Casey, citing competitive pressure in the sector right now. In addition, while he says some of this is already priced into the stocks, he doesn't see a need to revise estimates in near term. Now, with other players like Rogers, we have seen BMO lower the price target on the stock by $15 to 65, still maintaining an outperform rating on this year's. As for TELUS, BMO is also trimming the price target and lowering first quarter estimates. Another issue in that case that they are citing is some issues related to CapEx spending and margin recovery. Let's bring back Sadiq Adatia from BMO Global Asset Management for his view on sectors like the telcos. They have struggled this year. Competition once again being cited by an analyst. What's your take on what's going on right now?
Yeah, so I just want to allude that report is from our capital markets group.
Yeah, separate, same
very,
company, separate,
very
separate
smart
business.
guys there for sure that know what they're talking about.
Yeah.
And similar to them, I mean, nothing is wowing us in the telecom space. I think, as you alluded, competition is high. We don't see massive margins coming in there, not a lot of room for growth in our opinion. So it's not one of the areas that we see a strong momentum there, and therefore we're not increasing our exposure there. It's definitely not an overweight, and I think similar to what you saw in the capital markets report, kind of in that market perform category. So wouldn't put it in where we talked about energies, materials, or financial category.
Now, in this interest rate environment, we've talked about some sectors that have had to compete for attention with, let's say, fixed income. Is that another consideration for the sector's longer-term performance here?
Yeah, I mean, you have to think about yields, right? When you think about fixed income, so things like financials or, again, telecoms, utilities with other areas that would generally have higher yields are areas that you would tend to look at. But I just, again, you also want to get growth out of those yields. And I just don't see that in the same way that I see that in areas like financials.
Like you're getting the payment, but you also want to see the appreciation.
Absolutely, those are going to be secure, and then we're going to see growth in the dividend yields. And so far, we're not seeing that as much in that sector.
Okay, let's by comparison go to the financials, which are known for their yields, and you like this group.
I do. I like it very much. I think that over the last few years, we just haven't seen the momentum in those names, and rightfully so. You've seen some issues in the U.S. in particular that have put a cloud over a lot of these financials. But if I go back into the fundamentals, the balance sheets of these companies, they're very strong. They've diversified the businesses outside of Canada. The yields are strong. You're going to see continuation of growth of that dividend over time, and I think that we will see the interest rate environment be a bit more favorable as well. The margins across the board should be better. The only thing that I worry about is there are still going to be some low loss provisions there. And I do think that in Canada in particular, the consumer is getting weaker faster than the United States. So that would be the one headwind. But I think a lot of that is already priced into the markets.
I mean, what kind of growth can you expect for banks?
So it really depends on which bank you're talking about. I mean, the asset management parts of banks, the capital markets should be stronger going forward. Markets have been better this year.
Yeah.
So that should be a positive. And again, I think diversifying the business more outside Canada. So my own bank had a Bank of the West deal, which I think is great because the U.S. is very strong. So I think those type of acquisitions are very accretive and will play out over time. I don't think those are all fully priced into the markets, given the environment that we have been facing over the last couple of years.
And if you're constructive on Canadian banks, does that mean this whole narrative around mortgage renewals is going to play out over the next couple of years, which everybody seems quite concerned about, the idea being that interest rates are higher, maybe they come down a little bit, but you've got a lot of people that are going to cycle into a new mortgage over the next couple of years. That's broadly not a concern to you? Or?
No, that definitely is a concern. It's a concern on the consumer side for sure.
Yeah.
And that's the reason why we have the underweight to Canada.
I see.
Because we don't think they can support the broader economy in the same way they have, because a lot of their disposable income now will be spent more and more on mortgages going forward than they would have 6 or 12 months ago. And that rate will be much higher than when they negotiated previously. But hopefully we will see rate cuts that will dampen that a little bit over the next couple of years as well. But it won't be, a change in mortgage that's going to be beneficial by any means.
So I'm trying to piece all this together, like for the Canadian dollar, for example, versus the greenback. What's your outlook for the currency watchers?
We're bullish on the U.S. dollar still. I think that we will see the Canadian economy and central banks in Canada cut rates more and earlier than I think the U.S. So will strengthen the U.S. dollar. I think we're going to see more volatility this year, higher geopolitical risk. Again, that should favor the U.S. dollar as well. So a lot of things are favoring the U.S. dollar, at least for 2024. That might change when we get to 2025, and we see maybe some strength come off the USD in favor of the Canadian dollar, but not this year.
Super fast question, I guess. Do you consider currency performance when you're thinking about how to allocate capital? Because I guess if there's a stronger U.S. dollar, maybe that gives a little torque to your U.S. equity exposure?
Absolutely. I mean, that's why everything checks the boxes for the U.S. You got a stronger economy, a stronger consumer, and then a stronger currency as well.
Ulta Beauty is one of the worst performing stocks on the S&P today after the company said that the kickoff to the first quarter saw sales that were slower than expected. We're seeing the stock post its biggest intraday drop since the pandemic, March 2020. But our next guest has got a buy on the stock. Susan Anderson, Managing Director at Canaccord, joins me now. Susan, thanks so much for being with me. I do recall when Ulta reported its set of quarterly results, the forecast was a little bit lighter than expectations. And now here they are saying, the first quarter got off to an even slower start. What's going on at the business?
Yeah, so originally they said comps for the year in the 4 to 5% range, with the first half only up low single digits because they have tougher compares and then those ease in the back half. But then just today at the conference, they said that things have gotten off to a slower start than they expected, and they've really seen, a slowdown across all categories and price points. So it's not really specific to prestige or mass, it's really across all categories. So I think that's the big issue. And but with the stock down 15%, it does seem like it's a little bit overdone. They did say if things continued along these lines, then they would just be at the lower end of their guide, which indicates that they're still comping positive. It's just a little bit lighter than they had expected.
Why the slowdown? Are they losing market share, or is this a sector problem?
Yeah, well, it sounds like because it's across all categories and price point, it does sound like it's a sector slowdown. Prior to this, they have struggled in prestige makeup, in prestige hair, because investors believe that they are losing some share to Sephora as Sephora rolls out to more stores, to Kohl's stores. So if it was only relegated to prestige, I would say that maybe they are losing share. But I do think this is sector-wide. We've also seen it in the Circana data, which is primarily mass data. We have seen a slowdown recently across the board in that data as well.
It's taking down rivals and other beauty companies like Ulta Beauty, which you also have a buy on. Give me a sense of why you're still bullish on this sector, why you think these stocks are a buy.
Sure. Yeah. So, in the end, beauty and health and wellness is typically a category that consumers cut back last on, especially during weaker macro environments. And sometimes it even becomes a small luxury where they cut back on, say, a larger, more expensive handbag. So, longer term, I think it's a pretty resilient category. Yes, we may be seeing a slowdown as maybe consumers start to pick and choose more what they are going to buy, but I still see it as a better category to be in, especially if we are coming into a consumer slowdown.
Estee Lauder is one that you have a hold on, and one of your counterparts at another brokerage recently upgrading it, saying that, maybe we're coming to a sales inflection. Obviously, a stock that's had a very difficult time. What do you make of that? Do you think that there is possibly a turning point, or do you need to see more out of Estee Lauder in particular?
Yeah, so the big one with that is really China. That's where they've struggled in China in the travel retail channel. We have seen things maybe stabilize there. We're still seeing negative sales there, though. Also, there's some very difficult comps in China through about May. So I think we'll see after May if we do see an inflection point there. But I think that's going to be the big decision whether or not Estee Lauder can start to stabilize and start to move upwards. Their exposure to the U.S. and North America and the department store business, that's a little bit difficult as well, given the channel. And particularly if we do see a slowdown in beauty in the U.S., that could complicate things as they try and get back on track.
But we are looking at a positive start today for the TSX. On an intraday basis, we actually out the gate got within just a couple of points of a new all-time intraday high. And that speaks to the fact that this morning we've seen some of our discretionary stocks higher. Dollarama's better than expected quarterly results, doing some heavy lifting this morning. But in recent months, you've seen some of the material stocks and energy stocks finding their groove. And of course, coming off the lows last year, not only were we talking about technology stocks rallying, but we saw financials and industrials. So really the broadening out of the North American equity rally has benefited the Canadian market. Let's get some more perspective on what's been going on. Kim Ingalls is a senior portfolio manager at Raymond James. Kim, nice to see you. What do you make of this recent rally?
Well, I think that right now, investors are pretty reactionary one way or another, positively or negatively. I mean, we've seen, such a big run up in stocks over the last little while. The S&P 500 is up, 30 some odd percent over the last 5 months. So I think that investors, they're a bit anxious and edgy to both positive and negative. They're looking at news coming out and reacting on job reports, CPI, central bank announcements, and any kind of positive news, reacting well on that, and any kind of negative news, also reacting on that. So I think you're seeing a fair bit of that.
Right, yeah. Well, listen, if everybody's charging ahead, I suppose you could wonder why you shouldn't be doing so. But when you've got a big move in either direction, it does open the door to a fresh conversation. So if you're thinking about how you want to be positioned in this market, what have you been thinking about?
Yeah, so I mean, generally speaking, I like dividends. I always like dividends. But, I think that there's a lot of opportunity in the dividend space right now, because if you look at it, dividends have been largely ignored. Last year, dominated by seven tech stocks, which by and large means that the rest of the market was largely ignored. The rest of the S&P 500, as an example, the other 493 names, did about 10% last year. Dividend payers did about 6%. So, and yet valuations are still pretty undervalued. They're pretty inexpensive. You are seeing earnings still, going in the right direction. So I think that there's still opportunity to be had, and particularly in the dividend space.
Okay, well, let's go through some examples for our audience, because Johnson & Johnson is a well-known company in the U.S. healthcare sector, drug sector. It does have a long track record with dividends. Why does this one maybe fit the kinds of characteristics you're looking for in an investment?
Yeah, so Johnson & Johnson actually, in many respects kills two birds with one stone, because the other area that I like is healthcare. If investors are looking for what sectors are going to generally do well after rate cuts, healthcare historically has been the number one performer, actually. So Johnson & Johnson fits that. It's a great defensive company. As you said, it pays a great dividend, and it's done so for actually 62 consecutive years, so a good track record there. It's got a good growth profile as well. Targets about 4 to 5% revenue growth, 7 to 8% earnings per share growth. It trades at a discount. It's got a good balance sheet. It's got $23 billion cash on the books, so well positioned from a whole bunch of standpoints, but particularly with M&A. Interestingly as well, if you're an investor and wanting to dip your toes into the AI space, NVIDIA actually announced recently that it's partnered with J&J MedTech to essentially help use AI to help doctors with surgeries. So a little bit of exposure to that as well. So all around, I would say good long-term buy and hold position for investors.
Interesting context. And for those looking for broader exposure, which you were referencing as well, there's lots of ETFs. You were highlighting the healthcare select sector SPDR ETF in the US, gives you more broader coverage. Before I talk Canada, real quickly, you mentioned that if we move towards a rate-cutting environment, that healthcare can do relatively well. Do we know why that is?
Well, I mean, just historically, it has. I think that in general, it's a good place to be. I think that often investors kind of dip their toes in when they might be a little bit uncertain with things. So the healthcare has trended down, so I think that they move into that space. Okay, and then just staying on this dividend theme, just as an example for some exposure here in Canada, more broadly speaking, you highlighted an ETF that Dynamic offers, the Active Canadian Dividend ETF. What's the makeup of this that catches your eye? Yeah, so I like that one. It's an actively managed ETF, so you get a good management team in there that's good at doing good kind of Buffett-like approach to things, bottom-up fundamental. They're basically looking for companies with high margins, good market share, so kind of looking for that moat, so to speak. You will occasionally see some U.S. names in there because, of course, Canada isn't a particularly diversified index. So speaking on healthcare, sometimes you will see some U.S. names in there to get exposure to areas of the market that you don't really in Canada. 30 to 40 names or so in there, good track record, and you can get that for relatively low cost.
Well, for more on the jobs data, let's bring in Lorraine Seidel-Baker. She's an economist at ITR Economics. Lorraine, thanks a lot for joining us. Let's begin with the U.S. What's your take on the much stronger U.S. non-farm payrolls number?
In the U.S., this really continues the story we've seen up till this point this year. A very strong, very resilient jobs market. I'm surprised by the strength of this headline beat. Again, I would want to see the revisions in future months. We've seen some very big swings in past data revisions. February lowered very slightly. Again, that was still a strong number. So it seems that the U.S. market is still very tight, still very much an employee's market.
So the big takeaway is, of course, the big question on investors' minds, what does this mean to the U.S. Fed? Does it wait longer to reduce its interest rate? Will it reduce rates fewer times this year than many market participants have expected?
At this point, I would say at the margin, this large beat would give them a little bit of pause, but we have a lot of data coming before their June meeting. I think this is just one more input. This won't be the key input that, say, makes or breaks that move. So I don't think this takes a June rate cut off the table. I want to see what the futures market is pricing. But at this point, I think mid-year is still very likely, again, dependent on future data.
Lauren, it's John O'Connell. Good morning. What do you think the Federal Reserve Board really is focused on here? I mean, market participants seem to be looking every day for the new piece of guidance and jumping around. If you had to really guess personally what you think is going to happen a year from today with regard to the economy, forgetting about the data points, that I think the average estimate was 202,000 jobs, and nobody ever gets it anywhere close. What do you think is going to be, where the economy is going to be? Is it going to be stronger or weaker?
Well, the general direction is still that things are cooling off. So I think to your first question, the number one thing the Fed is taking away from this release, that is the wage data. And that for, I believe it was 4.1%, is still moving in the right direction. Chair Powell has said many times, we don't need to reach 2% inflation. We just need to be headed in that direction consistently, sustainably enough before the Fed starts cutting rates. They've also signaled, though, that they're in no hurry. They don't want to move too quickly. So they do want further cooling in that wage inflation number. Again, a big headline beat like this will certainly surprised the markets, but seeing that wage inflation continuing to cool, that's the Fed's number one takeaway. That's why I don't think we're too concerned with the June cut coming fully off the table with just this data release.
And you mentioned, Loren, that you'd be interested in what the futures market is pricing in. My Bloomberg screen is telling me that the U.S. futures currently at this moment pricing in a 69% chance of a cut at the June 12 meeting, a more than 100% chance of a cut at the July 31st meeting. Let's swing to Canada. There, once again, as is very, very common, we get a number completely at odds with what the economist community had been expecting. A modest loss of jobs, 2,200 jobs lost in the Canadian economy versus 25,000 jobs expected to have been added. And one of the numbers that really jumps out is the rate of unemployment in Canada is now meaningfully above 6%. And we should show viewers a view of the Canadian dollar because it is moving on these numbers as well. The currency market making a forecast on perhaps where the Canadian, what the Bank of Canada is doing. There you see the dollar dropping significantly on this news. What's your take, Loren?
This is the big surprise to me today. I did not expect job losses in Canada. Now, for quite a while, we have seen population growth in Canada exceed the rate of job creation. So that has been moving to cool the labor market, right, to ease some of that tightness in Canada. Increasing the unemployment rate up until this point. But outright losses in jobs, that I'm a little bit surprised to see.
I'm just going to tell viewers the same thing about the futures market. The futures market now pricing in a cut in Canada on June the 5th at 78%. And if not that, then a more than 100% probability of a cut on July the 24th, the following Bank of Canada meeting. Let's talk about these wage growth numbers, both, of course, meaningfully above 2%, which is the target of both central banks on inflation. In the U.S., wage growth coming in at 4.1%. In Canada, wage growth coming in at 5.0%. Are these wage growth numbers continuing to make it more difficult for the banks to tame inflation?
They are. They are certainly the stickier component of inflation right now. So we see overall producer prices starting to ease. Commodity prices, right, have flattened a lot. Even with some of these geopolitical tensions, shipping costs have come down. But wages are really that last sticky component that are keeping costs higher. So the central bank is very closely focused on that, and central banks globally. So we want to see businesses start to adjust. There is no real easing in the labor market, at least here in the U.S. in the near term. We're going to need to see productivity gains to take down these overall costs.